recognizing these before it happens, because that's a reasonable sell-off, guys, that could have dented a portfolio. As it turned out this morning, we've had a bounce and we've been able to save ourselves from a fate of selling coming into the beginning of the week. But it could have cost you a lot of money, guys, and you don't want to be doing that. You don't want to be missing out on some of these brilliant opportunities. So welcome in, guys. It's just after 1 o'clock. We'll run through the news. Not that there has been much. Data-wise, Australian retail sales disappointed at 0.1%. Forecast was 0.4, prior was 1.1%. So nothing much in terms of news in terms of the data-wise. Well, this afternoon we've got Lagarde coming out at 1:30 and at 3:15. We've also got Fed Speaker Williams coming out as well this afternoon at 8 o'clock. And that's about it. There's not really been many macro changes to any sentiment ideas. There's not really been very, very much. Obviously, the dollar's been quite an interesting story. I'll grab a chart of that and I'll show you what we've seen in terms of activity since I've been on and off. So here's the oil. Start running in the dollar. You can see that there was a bit of dollar activity up here. Price pinned out to the top edge and reversed. There was a bit of activity here in the early London session that caused that big rally. But the buyers didn't show up again at that price, and the price has been able to sail through. And since then, there's been absolutely nothing in the London session. Nobody doing any dollar business at all. Look, empty. Absolutely empty screens. So not an awful lot for us to get too excited about in this dollar at the moment. So nothing really, guys, for you, I'm afraid. Nothing really. Equities. Well, I've been looking at Max on a shorter time frame to see if we can get, a few more trades, of course, just to see if we can get more activity in the sessions. Of course, we don't really need it for the London session because it was doing a great bit of business in the London session. So we're not really that bothered about whether we do or whether we don't. But it'd be nice to know whether we could actually get some more business done if we wanted to in terms of cranking up the gas. And it works. I mean, obviously it works in the short term. It works in the short-term charts as much as it works in the long-term charts. So yes, the answer is yes, we can do it. And the question, of course, is do we want to? That's always going to be the big challenge, is do we want to actually crank up the gas a little bit to take a few more trades onto the book? Challenges, absolutely. The opportunities, absolutely as well. It depends on the view of trades. It depends on commissions. So something to keep looking at, guys, as well. Gold's just cracked south, which is great news for anybody that was following my discussion this morning. I was suggesting that you should only be short gold at the high prints up here, and it has just finally cracked south out of there. Selling off the highs was at 85s. It's dropped down to a low price of 80s. It's not the biggest trade in the world. But it's a trade, isn't it? It's a trade. It's the right trade. In terms of oil, we chatted about oil this morning. Had a look at calendars. Also supply and demand that we were talking about earlier on today. So oil on a 5-minute chart. We can see that the market is bracketed beautifully between the high prints and the low prints and the middle prints. You can see the supply that we've got at the higher prices. There's supply, real money supply in there. Real money demand at this price, meaning suggesting certainly that oil is now a very, very strongly bracketed story for the time being. And on the basis that oil is now a very bracketed story, we can obviously be aware that the market may well be rotational like it was last week. Because last week, selling off the highs, buying off the lows and rotating back into the middles, it's just basically a bracketed market, isn't it? But that bracket still has ranges. And for the scalpers, for the swing traders, those ranges can become quite considerable if you want to take a bit of business. We gave a supply area of $72 last night. It's sold off $72 this morning. And obviously the last demand area was around about this 71.26. The big demand is down at 70.40s. But there was a nice buyable opportunity off 71.30s. Rallied for another 30, 40 ticks on the buy side of oil, which is a great trade as well. great trade if you ask me, guys. A fantastic trade. Anybody buy some bonds there off the 20s? Nice trade. Nice trade off the 20s, guys. So what are we interested in oil in terms of this bracket? Well, one of the things we talked about this morning again was this very, very powerful concept of backwardation. Something that no oil trader can live without. They've got to have backwardation on their charts. Otherwise you're missing key pieces of information. If you look at backwardation, the vast majority of the times it's quite tight to price, obviously, because it's oil prices. But when you see sizable divergences, you know that there's a game afoot. There is something that could make you some money. Now, obviously, when you're looking at this, you might be wondering, why can you sell into highs, for example? Why would there be a possible sell when there's absolutely this rock solid? Because everybody's time frames are different. Everybody's frame of reference is different. As you drill down and there's other things starting to signal, obviously you can see into that top edge that there is a value divergence. The price sells off into the bottom edge. There's a value divergence. The price rallies. So yes, there is a macro context, and we alluded to that in the tweet from, we suggested that you have a look at the tweets in the big macro scale business before you make decisions. So the key to trading is this, the roller button on your mouse. Going from that picture to this picture allows you to remember about what's happening. It's not that big an ask, is it, Tim? Just a roller button on your mouse, guys. Just to roll backwards and forwards to see what the macro's doing, to remind you what the big picture is, so that when you're making a decision, you know whether you're with the picture or against the macros. You know whether the big boys are dumping stock or dumping futures, or whether they're in accumulation mode. I took a quick screenshot just because it was a very relevant example from a bond position. And I didn't have to go too far back to find a nice position, where in the short term it suggested there was a very interesting sell. In the short term, a very interesting sell trade. And then when you zoomed out, you realized that you were in a macro buy market. And you suddenly look at it and say, what the hell have I just bought this for or sold this for, when the macro is the exact opposite of what I'm doing? And a lot of times that's one of the problems. And I was kind of talking to the guys this morning about what some of the bigger problems really were. And some of the big problems are things like getting married to a position, not being flexible enough to get away from your position, instead doubling down into a position that's not defendable because you're just stubborn, or you're just not willing to accept that you made a mistake on a deal. And when you've done a mistake on a deal, you have to look at it and say, well, what am I looking for in here? The best thing you can do is cut your current positions. Cut your current positions and get away from that deal. It was a great trade on Friday. I sold some oil into the highs, and that's a great trade. I sold some oil here and I sold some oil here. I loved it. I was really enjoying what I was seeing. Now, obviously, when that price comes back up, I could sell some more oil, couldn't I? I could try and sell some more oil into that, and obviously when it came up at first, it was a good deal. Now, I know Cliff bought the oil during that phase. I exited during that phase when Cliff was buying. I was a buyer in here. Now, I sold here. Was it the right trade? Yes, absolutely. Of course it was the right trade. Was it the right trade on a macro scale basis? No. But I wasn't trading this on a macro scale basis, was I? This is what I was saying about trading. It's not about whether you're right or wrong. It's about whether you're right or wrong in your context, in your world, in your environment. So was Cliff right to buy the bottom edge? Yes. Was I right to sell the top edge? Yes. We both had different looks at the market. Cliff was taking a look perhaps more like this. You see the difference? I don't trade oil as in a lot of cases as a swing because it's not my primary market. My primary market is bonds. So I'm more likely to swing bonds rather than any other market on the planet. But in terms of the S&P, I'll buy and sell S&P on a 1 second chart. I'll buy and sell oil on a short duration chart. I'll go for occasional swings, but usually it's a short-term type scalp trade. So who's right and who's wrong? Who's right when Reeve buys bonds and Tim sells bonds? It depends on their perspective. What you've got to try and understand is your perspective is your perspective. It doesn't make anybody else's trade wrong. It makes your trade right or wrong against what you think is the trade. If you've got a perspective like Cliff, for example, last week on Friday, that you're long oil because of a macro, well, you've got a macro perspective. And what you're looking for when that's the position there, you're saying, okay, well, I see the short term coming in. Well, that short term was my selling. Does that give Cliff a great opportunity to buy some cheap oil? Yes, absolutely. Does it give me a great opportunity to exit some oil? Yes, absolutely. So me and Cliff are both buying at the same time. The difference is Cliff's buying to get long and I'm buying to get off a short trade. When the price comes back up, I'm still seeing a value divergence into that pullback and I'm still selling another bit of business. If I got married to that position, which I didn't, I could have lost a lot of money. And Cliff could have picked up all my losses. Because what would have happened, of course, is that if I sold in here, I could have lost a fortune here. Now, I sold this candle and I sold this pin. But at that stage, I recognized that this trade was the wrong trade. This trade was the wrong trade. When I sold this candle here at the 70, 75, 70, 80, the price actually dropped down to 70, 60. For a short-term scalper, I made 20, 25 ticks of profit. I can make a lot of money on those types of trades, guys, a lot of money. But obviously, if I got married to this, because obviously once that trade got taken out, there was a big acceleration here. Now, obviously, it would be up to me whether I decided to join the acceleration and flip my deal altogether, flip my deal at that stage, or whether I just accept that that I've missed the deal and let it go. Usually, I just accept I missed the deal because it's not my primary market, so I just pass on the trade and wait until another opportunity starts setting up. This is important because a lot of you guys will maybe see some other guys typing in the room that they're doing this or they're doing that. Michael maybe say he's in a buy trade in the S&P or he's in a sell trade in the S&P. And you might look at the fact that you're in the opposite trade and say, I don't understand that. I don't understand why is Mike in that trade when I'm in the exact opposite. But you don't know what Mike's term of reference is. You don't know what, if he hasn't put in an explanation about why he's short or why he's long, don't take it as read that he's wrong or right. If Cliff hasn't said whether he's buying because of a longer term perspective, or if Sammy comes in and says he's selling some oil, but that's it. Don't just think, oh, well, I better sell some oil. You don't know if he sold oil from an hour ago or from a day ago or from, from what perspective he's looking at, what his targets are, how long his duration is. You've got to try and understand those before you put these types of information points into your thoughts. Don't be taken in by somebody else's buying or selling. Don't be taken in by my buying or selling until you understand what time frame of reference I'm buying it on. When I say Max is buying, Max might be in the trade for 5 seconds. By the time I've said it, Max might be out of the trade. So just because Max is buying doesn't mean you all pour in and buy. Just because I'm maybe buying a bottom edge of bonds doesn't mean you pour in and buy bonds. You've got to try and understand the extent of it. You've got to try and understand why. And then the time frame of reference on the why. And then figure out what it is you want to do about it, what it is you want to try and see. We're getting a little parallel shift in bonds, so I'm not doing anything in bonds right now. I'm quite happy to let the parallel shift go. We haven't really seen another two stands. What we actually saw was a change in the, so that pushed the bond price back through for a sell. So selling off the twos would have taken you down to about 25s. Nice trade if you took it on the short side. Remember, sometimes one leads, sometimes one lags, but when the 2s 10s doesn't fall, but the 10s 30 starts to rally, it's time for you to get into that short bond trade because it was an unwind. I'll show you what I mean by that. So here's how it was setting up. What we saw was we've got there's the 2s 10. There's a lot of lines in this guy, so instead of taking them off for a second, I'll just quickly say what we were looking for. The 2s 10s had separated from the 10s 30s during this phase here. Now the question obviously is always going to be which one's leading, and the answer is you don't know. You're not going to know. You're never going to know which one's leading until eventually one of them capitulates. At that stage, what I'm looking for is I'm looking at the shape of the inflation break-evens, and I'm looking at the location of bond prices. Now, during this phase, what I started to see was the 2s 10s leading to the upside. But I also saw an average value divergence on the break-evens. So because bonds were at a bottom edge, I bought some bonds. Very easy trade. Made some nice money off it. I took some buys off the 2s. We rallied up to the 4s. And obviously when we rallied up to the 4s, what happened, instead of the 2s 10s falling, the 10s 30s started to rally. How do you steepen the 10s 30s? You sell the back end durations. So when the 10s 30s is underpriced and the inflation break-evens turned back up again, there wasn't a choice. You had to sell your bond position, whether you were in a long position or not. You had to sell your bond position to either get short or to get away from your long trade from earlier. And that's resulted in a very, very nice short trade that's resulted in this parallel shifting phase. So it's something to always watch when you're trading. Sometimes the 2s 10s is overpriced. Sometimes the 10s 30s is underpriced. If you get it wrong, you'll be in the wrong bond trade. Now, when I say when you get it wrong, was I wrong to buy the bond at the bottom edge? No, because that's the trade that was setting up for me. I had a bottom edge bond and I had a curve that was overpriced on the 2s 10s. Was I aware of the 10s 30s starting to steepen back up? Yes. Should I be fast to take profits on this? Yes. Should I be watching the inflation break-evens and the equities and the oil? Yes. Was I? Yes. And did I get away from that long trade? Yes. It's not as difficult as you think, guys. It's always response and reaction. When that starts catching back up, the bond price has no choice but to drop. It's part of that same trade. It is that trade. And when the bond price drops, the question is, why is it dropping? And that's called a parallel shift. You never fade a parallel shifting market, right? You never fade a parallel shifting market. Because obviously now what's going to happen is, what we would expect to happen is we'd expect to see that the fact that the 2s 10s was already feeling a little bit of pressure. What I'm now looking for is what's happening just now. You'll start to see this starting to set up. You'll see the 2s 10s starting to come out, one would imagine, on any uptick of the 2s 30, so that one, the 10s 30s coming out on any uptick in the 2s 10s, on any divergence of oil prices, break-evens, and that's going to start putting in the possibility of a bottom edge. It's going to put in the possibility of a bottom edge bond. Now, obviously, one of the reasons why we also got that sell-off was the sell we just encountered on gold. A trade that we called live in the room, guys. Just look at what happened. We said if you're going to do anything, you're going to be selling gold for this market top edge. And you see that the gold short from 85s has just traded 75s. That live call was $1,000. Congratulations, anybody that made their morning's money on the short gold call this morning, guys. Beautiful trade. Expected? Not really, because obviously the dollar hasn't really come off that much. But we can obviously look at the euro dollar. and recognize that it's probably gone further than you thought it was going to go. As a result, coming into this prior level, a great place to just say, you know what, 75s, I think I'm happy with that. I'm going to take a bit of monies. Thank you very much. What a trade, guys. What a trade. Congratulations on your $1,000 membership, guys. Beautiful. So welcome in. I'm going to grab a bit of lunch. I'll be back in 10 minutes.